All states swear that their money is safe. All leaders claim their promises will last forever. And every time, history proves them wrong. From Rome to France, from the Confederacy to modern Lebanon, people have woken up to find that their wealth was worthless, their wages meaningless, and their future stolen by the very systems they were told were secure. Collapse is not rare. Destruction is the rule. The real question is not whether financial systems fail, but how you protect yourself when they do. The illusion of permanence is the most dangerous financial loss of all. We look at our bank accounts, our national currencies, and assume they are necessities, but money is not a necessity. Trust is. And trust can disappear one morning when you wake up. That is why history is so brutal and so useful. Every collapse leaves behind lessons, patterns, and warnings about what truly protects wealth and what turns to dust. And if you look closely, you'll notice something unsettling. The ones who survived were never the ones who trusted the system the most. They were the ones who became cautious first. Take the Byzantine Empire, for example. Often remembered as the eastern half of Rome, this civilization somehow outlived the fall of the Western Roman Empire by nearly 1,000 years. At the heart of its economy was the gold solidus, a currency so reliable that merchants across Europe, the Middle East, and Asia accepted it without question. For centuries, it was the closest thing the medieval world had to a global reserve currency. You might think Byzantine emperors learned from Rome's collapse, where silver denarii were repeatedly debased until they became little more than tin coated in silver. This story has been told before, but no. Centuries later, the Byzantines faced the same problem with gold. They began reducing its purity, thinning it, mixing it with cheaper metals. At first, no one noticed. Then trust collapsed. A currency that once guaranteed Mediterranean trade became just another political instrument. Debasement destroyed its credibility, and with it, the stability of the Byzantine economy. So what survived? Not paper promises, not imperial decrees. Merchants who secretly stored gold or land outside imperial reach preserved their wealth, while everyone else watched their money disappear. This was the first lesson, one that is often ignored. Governments cannot resist the temptation to dilute their currency, and when they do, real value flees into things they cannot counterfeit. But not every collapse comes from monetary manipulation. Sometimes it comes from unexpected shocks. In the mid-14th century, Europe faced the Black Death, the most devastating pandemic in its history. Between 1347 and 1351, nearly half of Europe's population died. Cities emptied, villages vanished, trade routes collapsed. Yet the economic story of the plague is more complex than simple destruction. When half the workforce disappears, labor becomes valuable. Survivors could demand higher wages. Food and land, once scarce, became abundant relative to people. Households with liquidity, silver, goods, or simply the ability to work suddenly gain power beyond imagination. Land that once symbolized wealth could be bought cheaply. Homes stood abandoned. Fields lay unused. Those who could still breathe were in a buyer's market. If this sounds disturbingly familiar, it should. We saw a modern version during the COVID pandemic. Supply chains broke. Governments printed billions to keep the machine running. Those with liquidity bought assets, while single-income workers fell behind. In the United States, housing prices soared. Stock markets rose. Millions of ordinary people struggled just to pay rent. Everything was in plain sight. Pandemics redistribute wealth. They always have. Black Death survivors rose socially because of scarcity. COVID survivors with liquidity bought homes, stocks, and factories that others could not afford. Uncomfortable, but true. Major crises reward those with reserves and punish those without. And just as plagues show how quickly shocks can destroy economies, so too does the collapse of banking institutions. In the 1340s, Florence was Europe's financial capital. It was home to powerful banking dynasties like Bardi and Peruzzi. These houses lent enormous sums to rulers, most notably to King Edward III of England. When Edward defaulted to fund his wars against France, the banks collapsed. Depositors were ruined, trade froze. Chaos spread through a city once seen as untouchable. Ordinary citizens learned a brutal truth. Size does not equal safety. Reputation is not protection. People realized that the lie of too big to fail is as old as finance itself. Institutions exist to make money, not to guarantee your survival. When they fall, they take your money with them. This repeats every century, from Florence to Lehman Brothers in 2008. From there to Lebanon's banking freeze in 2019. You survive only as long as you do not believe institutional promises. The American Civil War is remembered for battles, politics, and the end of slavery. But behind the gunpowder was a brutal financial war few modern Americans understand. Both the Union and the Confederacy realized war required printing money. The North issued greenbacks, paper money backed not by gold, but by the authority of the U.S. government itself. At first it felt bold and patriotic, but as more money entered circulation, purchasing power fell. The South fared far worse. The Confederacy printed massive amounts of graybacks. By war's end, inflation had reached absurd levels. Prices rose thousands of %. Wages became meaningless. Soldiers' paychecks lost value before they could be spent. Families carried piles of cash that could not buy a loaf of bread. By 1865, Confederate currency was not weak. It was extinct. What mattered wasn't paper promises. It was tangible assets. Land, food, gold. Anything real retained value. Money became brutal. For ordinary Southerners, lifetimes of savings vanished. For opportunists with access to physical goods, war became a chance to acquire wealth cheaply. A lesson Americans rarely hear, and we must never forget. Your own country has experienced currency loss before, and when it happens, protection does not come from trusting the cash in your wallet, but from holding value that inflation cannot erase. Revolutionary France offers another ruthless example. In the 1790s, after overthrowing the monarchy, revolutionaries seized church lands and issued assignats, paper money, supposedly backed by confiscated property. Instead of restraint, the government printed endlessly. Each issuance devalued the next. Prices exploded. Wages lagged behind. Farmers refused paper money, demanding goods or silver instead. Even bread became scarce in Paris. Riots followed. The revolution consumed itself. The winners were not patriotic paper holders. They were those who owned food, gold, or land, things the government could not print. For ordinary Parisians, it was too late. Promises, no matter how noble, are temporary. They are only worth what others believe. When trust disappears, wealth doesn't shrink. It vanishes. Fast forward 2 centuries. In 1997, a speculative attack on the Thai baht triggered the Asian financial crisis. Thailand had borrowed heavily in US dollars, believing its exchange rate was stable. When the peg collapsed, foreign-denominated debt became a nightmare overnight. Capital fled. Currencies across Southeast Asia collapsed. Indonesia, Malaysia, South Korea. Economies contracted. Jobs disappeared. Governments begged the IMF for bailouts. The worst affected were not hedge funds. They were ordinary citizens, those whose savings evaporated, mortgages doubled, and livelihoods collapsed. Once again, the pattern was familiar. Those with foreign currency or offshore assets survived. Those who trusted local money suffered. Local collapse was, once again, a global wealth transfer. From Byzantium to Argentina, the lesson repeats. Borrowing someone else's money ends nations. When the storm hits, borrowers drown first. Everything became clear. Whether revolutionary France, the American Civil War, or modern Asia, the same failures repeat. Paper money collapses, debt chains families and nations, and the survivors are never the most faithful to the system, but those who see its fragility early. The most frightening part. Collapse is not ancient history. Between 2019 and 2021, Lebanon's banks did something unthinkable. They locked their doors. Citizens woke up to frozen accounts, withdrawal limits, and vanished savings. The Lebanese pound lost over 90% of its value. Lifetimes of savings became pocket change. People begged outside banks, doctors, engineers, retirees. Trust wiped out an entire middle class. The truth was brutal and clear. Your bank account is not a vault. It is money you have given to an institution that may decide not to return it. Those who survived best had assets abroad, gold, real estate, or cash outside the system. Everyone else was trapped. If this feels distant, it shouldn't. In 2008, Americans lost homes and pensions while the banks that caused the crisis survived. In 2020, trillions were printed, saving markets, but stagnating wages. In 2023, U.S. regional banks collapsed almost overnight. Too big to fail is a lie we tell ourselves, until the doors close. So how do you protect yourself when everything disappears? History shows there is no single answer. Gold mattered in Byzantium, liquidity after the Black Death, skepticism in Florence, durable goods in the Confederacy, food and shelter in France, avoiding foreign debt in Asia, escaping banks in Lebanon. Times change. The problem does not. Survival does not come from blind trust in paper or institutions, but from recognizing real value when illusions collapse. Here lies the paradox. Collapse is both tragedy and opportunity. For the unprepared, it is ruin. For those with resilience, liquidity, or hard-to-produce assets, it is a chance to build wealth at a fraction of former prices. After the Black Death, peasants became landowners. After 2008, those with cash bought foreclosed homes. Protection has never been just defensive. It is also about what you acquire when others lose faith. Wealth is not only what you own, but what you can do. Those who survived history's collapses weren't just landowners, they were producers. The baker who could still make bread, the craftsman who repaired tools, the farmer who could grow food, the merchant who could trade across borders. In every crisis, money fails, production does not. People must still eat, build, trade, and live. Those who can provide real value never remain poor for long. That is protection, not blind faith in institutions, not belief that governments or banks will save you, but understanding that illusions always collapse, and preparing accordingly. Every crisis is a transfer, from believers to planners, from paper promises to tangible value, from passive savers to active builders. History shows this again and again, so the question is not if everything will collapse. It will. The question is this: will you be one of the many who cling to promises, or one of the few who hold real value? History does not repeat itself. But if you ignore it, it will destroy you all the same. If you enjoy content like this, subscribe. The answers we seek are buried in history's dust. I'll show you how to find them.